Hello folks, Steve Lentz here with Discover Options. Welcome to this presentation of 3 different SPX market timing reports for advanced options traders. This will be for Friday, May 18th, getting ready for the open on Monday, May 21st. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started with these reports, please click the subscribe button. That way you'll get notified when we have new videos coming out. And also, we have a free e-trading ebook on trading options, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click the link, give us your information, we'll get that right out to you. All 3 reports pertain to the current market condition, and we display the current market condition and describe it in 3 different dimensions. We consider market condition to be a function of price action, trend, and then the stochastic situation. In terms of price action, Thursday was an outside bar, followed by Friday's downswing bar. That price action, that 2-bar price action, occurred while we are above the 50-day simple moving average. And the stochastic is trending downward. The 15-3 stochastic is trending downward underneath its 3-day percent D between a range of, say, 60 and 100. Now, all 3 dimensions make for a market condition that has occurred just 60 times, 60 times since January of 2000. Isn't that something? And that's because of that outside bar. You just don't see too many outside bars, in the SPX. And so when you combine that with the, being above a moving average and then having the stochastic situation, only 60 times has this particular market condition occurred. So let's begin with the Condor butterfly timing report. The question on the table here is, based on this market condition, is now a good time to put on a condor or a butterfly? So here's how we do this. We look at going back, and we just look at the benchmark of the S&P 500 going back to January of 2000. And we've had roughly 4,616 closes since then. Now, of those 4,616, 64.8% have been favorable bars. Okay, almost 2/3 of the bars have been favorable for selling options premium because where the actual 21 bar movement, subsequent movement, was less than what the options time premium was implying. And to ascertain that, we look at the CBOE skew adjusted VIX to get that implied movement. So once again, roughly almost 2/3 of the time, the SPX will have a bar that is a favorable one for selling options premium because in a market neutral, delta neutral sense, like condors and butterflies, because the subsequent 21 bar movement is less than what is being implied by the option prices. So that's what a favorable bar is. Now, also during that time, our current market condition occurred just 60 times. Now, of those 60, exactly 2/3 were favorable, 66.6, which is a little bit higher than the benchmark of 64.8. So we're right there pretty well, just a little bit higher. 66.6% of the bars were favorable of those 60. Now that implies a very small premium selling edge of 1.8%. Very, very close. Statistically, it's technically more likely than usual that our current market condition will end up being slightly favorable or more favorable for market neutral option premium selling. Okay, so that's the Condor butterfly timing report. Let's go to the bull put spread timing report. Here we're looking at the notion of selling puts a standard deviation away 30 days out, and we're just looking at the statistics behind that relative to our current market condition. So, of those 4,616 closes of the SPX, 82.8% of the time, they were favorable bars for selling put premium like I described, a standard deviation away, 30 days out, 21 trading bars. Okay, if they were favorable, where the actual 21 bar downside movement was less than what was being implied by the CBOE skew adjusted implied movement to the downside. Okay, one more time. Okay, 82.8% of the time, the market did not move down as much as what the implied volatility was implying. That was a favorable situation. So so that's the benchmark. Flip a coin, 82.8% of the time, you'll sell puts a standard deviation away, and the market will not hit that level. Okay, and they'll expire worthless. So also during that time, though, our current market condition occurred 60 times. Of those 60, 83.3% of those bars were similarly favorable for selling puts like that. That implies a put selling premium edge, a put option premium selling edge of about 0.5%. It's very, very close once again. All right, so that's the the bull put spread timing report. All in all, on the Condor's end and bull put spreads, very slight edges right now, given the statistics on past occurrences of our current market condition. Finally, we come to the market likelihood report. And what we're doing here is we're looking at first the benchmark level at which you see 5, 10, and 15 period rates of change. So we know since Jan of 2000, the market's gone up. On average, when you take one close and look at the close 5 days later, you'll have roughly 0.1% of an increase. And so we can see that in this top line here, right here, the 5-day rate of change is at 0.10, 0.1%. You can take any close, go 2 weeks later, on average, looking at all 4,616 closes, going forward 10 bars, on average you'll see about 0.1% to the upside. And then the 3-week rate of change is just over 0.25% rate of change. Now, when we look at our 60 occurrences, okay, when you look at our 60 occurrences, the 5-day rate of change of those 60 occurrences is to the downside 0.12%, more than 0.1% to the downside. Now, is that a big deal? How big of a deal is that? Because instead of going up 0.1%, it goes down 0.12. That's a difference of pushing 0.25%. Is that a big deal? Well, to determine that, we just take that amount and determine what percent of a standard deviation that is. And we find over here, when we divide it into the standard deviation of 0.81, we get a z-score of 0.27. So it's roughly about 1/4 of a standard deviation to the downside is what that difference is. And is that significant? Well, let's look at the others. You got the 2-week 10-day rate of change of 0.07 to the upside. That's less than 0.19, of about 0.12 to the downside. And so that's to the downside a z-score of 0.11. Nothing to write home about. And what's interesting here is of those 60 occurrences, the 3-week rate of change is to the upside, 0.44%. That's much higher than the 0.28. So that's about 0.1% to the upside, about 1/10 of a standard deviation to the upside. So again, nothing really too much to write home about across the board here. Now, here's where things get tricky. We take those 60 occurrences and divide them up into those times when the market penetrated Friday's high. Okay, starting Monday, if the market goes up above Friday's high, well, what was the rate of change in that situation? And then what if the price goes down below Friday's low here on Monday tomorrow? Well, we'd take a look at what the rates of change were in that situation. So of those 60 occurrences, 23 times price went above the previous day's high, so above Friday's high. In that situation, you can see then an advance of 0.6, 0.16, and 0.43. Look at the z-score here. 0.62 on the 5-day z-score. That's over a half a standard deviation to the upside. And that's the most significant thing we see here. On the downside, subsequently, instead of going up 0.1, it actually goes down 0.41. That's a z-score of down 0.62 of 62% of a standard deviation, over a half a standard deviation to the downside. So pay attention on Monday. That's the motto here. On Monday, pay attention. You'll have a likelihood that in the short term, price is going to continue in that particular direction, either to the upside if it goes above Friday's high, or to the downside if it goes below Friday's low. That's what we're looking at here. In terms of realized volatility, the benchmark here, on average, you'll see an annualized volatility level, a realized volatility level, taken from 5, 10, or 15 bars, roughly between 15.5% and 16%, annualized. Now, in terms of our 60 occurrences of our market condition, when you go back and look what the realized volatility was in those situations, it's quite a bit underneath the benchmark. Okay, we're looking at something in the 12s typically. Okay, so lower volatility level relative to what the typical volatility is in the broad market. If we break it out in terms of price exceeding the high of the bar on Friday or the low, it does make a difference. If it goes above the high, you're looking at something in the 11s. If it goes below the low, looks like historically we've been in the 13s or so. Contrast that over here with the VIX. We have the VIX at 13.42. The 9-day VIX was at 11.48, a bit underneath the 30-day VIX. And so when you compare that, the VIX numbers here with the likely realized volatilities coming up, we could see here we're kind of right in the ballpark. It looks like the VIX is just a little bit higher perhaps. And that kind of could reflect what we saw earlier in that, the butterflies and condors and bull put spreads historically have had just a slight edge, very, very small though. Okay, nothing too much to write home about. I hope this is helpful information for you. If you have any questions, comments on the material, you can always shoot me an email, steve@optionview.com, and with Discover Options as well. Thanks for joining us. Have a good week trading. Bye-bye.